Welcome all and happy Halloween. I presented last year and we went through, I think I focused primarily on IFRS 9 and 15, that being financial instruments and revenues under contract. I'll be going over those at a pretty good pace this year because yes, you were all here last year, I take it. And I'll be focusing on IFRS 16, which is the new lease standard, and it probably affects more people in the room than you realize. Last year I mentioned I have a lot of trick-or-treaters that come to my home, usually in excess of 1,000, so it's quite a volume. And so after this presentation is complete today, I am not going to be one of those people mingling afterward. I've got to run and go greet those little goblins. So the standards, as I mentioned, you got 9, 15, and 16 financial instruments, revenue, and leases, respectively. And there's also some narrow scope amendments that I'm just going to absolutely gloss by, and some honorable mention on some of the industries that are causing us some IFRS issues, that being cryptocurrency and cannabis industries. And I do call this a What the Heck series. And as I go through, I will have the odd snapshot of my Halloween festivities start out at the beginning of the day, and as it gets darker, you'll note what happens. But this is basically the setup that we typically do. Do it down on the driveway, no kids get to come upstairs. So, to start with, IFRS 9, effective for already in effect, really January 1, 2018. It uses a business model test. And it affects primarily long-term loans, equity investments, and what I'll call non-vanilla financial assets, as well as hedging. Not going to go over hedging. 2.5 classifications, I guess they can call it 2, amortized cost and fair value, but amortized cost can have 2 components to it. You can have amortized cost, which is the one we're used to seeing out there. It's called the effective interest method. And if you're holding your receivables for sale, you would use amortized cost for sale and fair value. First thing to do, determine what kind of asset you've got out here. Is it a receivable or is it an equity item? If it's an equity item, straightforward now, it is at fair value. If it's a receivable, you've got to determine if it's a vanilla receivable or what I'll call an other receivable. If it's vanilla, really, it's like a receivable. You're just intending to hold it. Maybe there's an interest rate attached to it, and you are going to collect your receivable at the end of the term. The other receivable is measured at fair value through profit or loss, and that would be a more complex receivable, maybe something like a compound receivable. That would be a receivable that has both a receivable component and an ability to convert into equity of the lendee. So if your financial asset is equity, that's shares in a public company or a private company, you've got a choice. It will be at fair value, but you can measure it through your income statement, fair value through profit or loss, or fair value through OCI. You choose this at election. The warning is, if you choose that fair value through OCI, it never hits the P&L, and that includes on sale. It just moves over to deficit. Doesn't go through P&L. So careful of your choices. And always, here's a good one, show off your analysis to your audit committee, to your board of directors and your auditors. You really do have to show us that the work has been done. What kind of work? What the heck? This is really what you're looking toward right here. The old ones are on the left-hand side under IS 39, fair value through profit or loss, loans, receivables held to maturity and available for sale, and you have some choices about what bucket to put them in. You will need to document what bucket you've put them in and what kind of analysis you've done to survive an audit. This is just a little more daytime prep work for those goblins that'll be visiting me later in the day. As to those receivables, they're measured using a new impairment model. It's the expected credit loss model, ECL. And there's a 12-month ECL, lifetime ECL, and credit impaired ECL. And this is kind of just a diagram of what happens as you increase your credit risk. It simply has more effect on your balance sheet and more effect on your income statement. But the moral of the story is, at the front end of this, measure what your expected losses are and book accordingly. For trade receivables, you can use a simplified approach. Record your lifetime ECLs right at the front end. And here is a what the heck for me. I think there's a bit of a conflict under IFRS for measuring those complex receivables. Complex receivables, instead of being shown on the balance sheet as two components, and I mentioned earlier there might be a receivable with a convertible component. The conversion is really a derivative. And that would, in the past, under IAS 39, would have been shown separately. Now it's just grouped into one number. So in theory, you would just add those two numbers together, and that would be the value of your complex receivable. The guidance indicates fair value on day one is the transaction price. The problem is, from a practical perspective, those components can actually have a higher value than the transaction price itself, particularly when you use valuation models like Black-Scholes. So that determination really is not out there at this point, but I understand it is being looked at by regulatory bodies. Financial liabilities pretty much stays the same. No change, fair value through profit or loss, and other or amortized cost. Disclosure, hey, just more, some analysis required, information on credit risk required for disclosure, and reconciliations. Transition should be applied retrospectively, no requirement to restate the comparatives. So it's go forward. And this is the commencement of kind of the crowd coming through our driveway. I've got a couple of daughters on the right-hand side greeting. Yeah, I'll show you what happens when it gets darker. On to IFRS 15, revenue from contracts with customers, again effective January 1, 2018 for years beginning on or after. One comprehensive model to account for revenues. Replaces 6 standards. The thing is about 50 pages long and it has lots of examples, so it's a great place to look. You should be able to find your example in there. The idea here, the difference is that under the old model it was risk and reward. Now it's whether you have control of a good or a service. So that's your change. It's principles based, but as I said, there's over 100 examples out there. Document how the requirements in the standards are met. So this is about documentation. Again, show your work. Biggest impact, telecommunication, real estate, and licensing. I can tell you the mining industry. I was at a session a few weeks ago. It sounds like about 3% effect on operating mines. So the effect of the revenue standard for a lot of people in this room probably is not that big. But if you have it, there's a big increase in disclosure. There's a 5-step model to achieve the core principles. You identify the contract, identify the performance obligations, determine a contract price, allocate that, and then recognize it as your obligations are satisfied. And there's a whole bunch of slides here that tell us now how to identify the contract, identify the performance obligations, how-tos. I'm not going over them, as you can tell. I'm just kind of flipping by them. You can, at a later time, visit our website to see these slides if you wish to go there. And so it's available for you at a later date. You don't really have to take notes. Most people can't write as fast as I just went through the slides. The big one for disclosure is this disaggregation of revenue. It takes a fair amount of work. Transitional approaches, you can do full retrospective or modified. Most people are going to do modified. That's pretty much a go forward. Just adjust retained earnings for previous effects. This is when it gets darker at my house. Left-hand side, family and friends. Right-hand side, my daughter with a cleaver through her head. I can show you what that looks like in real life. It's not quite as bad. It just kind of fits over like this. And I actually do have to occasionally, for the little kids that start crying, do that. And that is me on the right-hand side. Or in your case, yeah, still right-hand side. Now on to the big one, IFRS 16 leases. And this affects a lot of people in the room, and a lot of this session is just about awareness, and then you can go into the details and you can ask your auditors, phone us, ask for help later, but the idea is to get an impression of what you're in for here. The effect on this standard, it's effective for years beginning on or after January 1, 2019, and it affects the lessee. Capitalizes all but immaterial amounts or short-term. Short-term being less than a year, and for practical purposes, I would say about $5,000 for the value of the related asset would be an expedient number that you could not have to worry about this standard. So if it's over a year, or if it's over $5,000 in value, you're in this standard. Who does it affect? If anybody has an office lease, a retail warehouse space, vehicles, equipment, and other arrangements, you're affected, pardon me. So if you have an office lease, you're going to have a right to use asset on your balance sheet, and you're going to have a lease liability. And you get to play around with that in the accounting world, and I'll go through a little bit about how to do that. Before you think you have a lease that you've got to do all this assessment on and calculation on, look through the exemptions, because the exemptions are going to include mineral properties, oil and gas contracts, biological, service concessions, licenses of intellectual property, and rights held by a lessee under certain licensing arrangements. So you could be scoped out. There is a practical expedient, as I mentioned earlier, $5,000 or less than 12 months. This is the definition under IFRS. As auditors, we sign off that your financial statements are in accordance with IFRS. This is what it says. And I'm going to read this, and I'm going to pause a little bit because I want you to think about it. At inception of a contract, an entity shall assess. Shall means you must in the IFRS world. You shall assess whether the contract is or contains a lease. That means you've got to go through and basically catalog all of your contracts and assess them to determine if they have a lease or not to be in accordance with this standard. And you've got to show your auditor that later on. And what is a lease? If the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. There's an identified asset when the lessor can't lessor, person providing you the asset, can't use it for their own benefit. Or right to obtain substantially all the economic benefits, the right to determine how to use it, decisions determined before the period of use, and protective rights. So these are requirements for identification of a lease. The components, you've got leases and you've got kind of non-leases. You can account for each one separately unless you apply a practical expedient again. And if you're ever going to apply a practical expedient, you need to disclose that in your financial statements. There's a portfolio approach. If you've got a lot of similar leases, you could group them together. Again, a practical expedient, so you would have to disclose it. As to the measurement of a lease, it's pretty normal if you've seen calculations for leases. You need a term, the payments, a discount rate, and calculate the present value of the future lease payments. This is not my yard. This is my neighbor's yard, and I put this one up because that head in the center between the two candles, that's Doug. That's my neighbor. And people walk by it, the little kids walk by, and then he'll start talking to them from the middle of that table. It's really, really very entertaining. Just going through some of the lease measurements. The term, it's the non-cancelable period, together with an option to extend or an option to terminate if it's reasonably certain that you either exercise or not exercise, depending on which one I'm referring to here. So it's your non-cancelable period plus an option and a potentially option to terminate. Measurement of payments, there's fixed payments and in substance, those are unavoidable payments. Variable payments with linked index, I don't know that we'll see too much of that, but they're around. Lease incentives, you would deduct them. A purchase option, if it's exercised or expected. A termination penalty, and residual guarantees. So that's the components you would put into for your present value calculation. As to the discount rate you're going to apply, this is kind of nice. You can either use an interest rate implicit in the lease, or if it's not readily determinable, and sometimes it's pretty hard to determine that, you can use an incremental borrowing rate of the company. And then you do your net present value based on the lease term, the payment that we just went through, and the discount rate. And what do you include in, what does that do on your balance sheet once you've got that calculation? You've got a lease liability and an offsetting right to use asset. That's that office lease, warehouse lease, vehicle lease, whatever it might be. You've got lease payments before the commencement date, initial direct cost, and decommissioning estimates. All of those go into the right to use asset. Reassessment of a liability. If there's a change in any of these items on this slide, you're going to have to remeasure the lease. If you change the term, option to purchase, guarantees, index, that change is going to change your lease liability, your right to use asset, and likely have a P&L effect as well. Lease modifications kind of continue. You would remeasure and account for it as a separate lease or just an increase or decrease in an existing lease, depending on whether you're adding any right to use assets. So if you're increasing right to use assets, chances are you've got a brand new separate lease. Otherwise, just make alterations to the asset, to the liability, and again, you'll have a P&L effect in all likelihood. What does this affect in your financial statements? Well, this is the what the heck. You get a right to use asset on your balance sheet. That's the asset with an offsetting lease liability. On the statement of operations, you're going to see increased interest expense, accretion of the loan, depreciation of the asset. Statement of cash flows, you're going to have a ton of non-cash transactions in there to add back, and you're going to have principal repayments on your leases as a financing activity. Then you're going to have new estimates and judgments to disclose in note probably 2 or 3 of your financial statements, as well as all of the disclosure requirements that you're going to have to meet. So this has a huge impact. This is going to hit everything in your financial statements. When it does so, it's going to be, for a lot of companies in this room, or a lot of people in this room, it's going to affect you in Q1. Q1 is usually right after an audit, and you've got breathing time of a month maybe to get it done. You are not going to have time to get it done in that time period. You're going to have to do this much earlier, and that's really the intent of me being here today, is warning you, start it, get it done. As for the transition, you can choose the full or modified approach. Suggest modified, that way you don't have to restate your prior periods. You will need to show the reconciliation and any cleanup items with it. On an ongoing basis, you're going to have to watch out for a few things. That's changes in the lease terms. We went through modifications a few moments ago. You can have embedded leases within service contracts. So don't assume for a moment that just because I have a service agreement that it doesn't include something that could be construed as being a lease. Maybe there's an asset that they're holding for your use only, which could be construed as a capital lease. So remember the standard, it says go through every contract and assess it. And as well, subleases, hey, you can be an intermediate lessor if you're subleasing your space out. If it's a sublease, you've got financing or operating. Now you're talking from a lessor's perspective. And if it's financing, you've got derecognition as part of the asset. But watch out, because that liability has different counterparties, so it gets complex. What the heck, internal documentation. You will need to substantiate that you have assessed all of your contracts. You're going to need to create a list. This is what I would be doing. I would create a list of all leases with a summary of the terms and the expectations and estimations as to whether you have a capital lease or perhaps a practical expedient. Show off your work. Show off your work to your audit committee, to your board of directors, and to your auditors. Let them know you did the work. And if you haven't done the work, start now. This is that at the beginning of the slides, I had the little setup in our driveway. This is when it gets darker. This is what it looks like inside once you're starting to deliver candies. So I'm going to move on very quickly, and I'm just going to flash through this really narrow scope amendments. I have them in numeric order, not in any order of importance. I'm just letting you know there's several out there. So accounting does continue to modify itself. Those are ISs. These are the IFRSs. So there's plenty coming. The only one I had interest in really is an IFRIC that's going to be coming out, and it's uncertainty over income tax. And that's if an entity chooses tax treatment that is not probable to be accepted by tax authorities, you should recognize that in your financial statements. Detection risk is not considered. So getting caught or not getting caught, it's not really the question. The question is it probable that it'll be accepted by the tax authorities? So we're keeping an eye on that one right now, and you may be interested at some point too. Honorable mention, the cryptocurrency industry. We've determined, hey, it's not an investment under IAS 39 or IFRS 9 because it doesn't have a contract. It's going to be an intangible, or it's going to be inventory. And if it's inventory, a couple of different ways to measure it. You're going to have revenue recognition issues for minors. Lots of consideration for this stuff and lots of position papers. If you're in this space, you've got to try to figure out where you are and really draft it out on paper and create a position paper. The Canadian accounting bodies and regulators, they're working all the time for guidance, but they have to keep it within the existing IFRS framework, which may or may not fit very well. Honorable mention to cannabis, biological asset, again, revenue recognition issues coming at you, differing application of fair value on that biological asset, and differing components of cost of sales. There's no specific guidance as to what to include. You can have fair value changes in COGS. It can result in your gross profit being higher or lower than sales in some cases. October 17th, Canada reduced that haze of cannabis through its legalization, so we now know that it is legal. There are cross-border considerations. The United States is not very friendly at a federal level to cannabis. I'm saying this from an accounting perspective. It's probably quite applicable to a personal level as well. IFRS discussion group has a lot of discussion on this in June 2018, and I think Peter is going to be going over some of the IDG stuff. Again, the accounting bodies are working on it. The regulators are working on it to provide guidance within that existing framework. So to recap, IFRS 9 affects just about every company, at least for disclosure. It's classifications based on a business model. You've got a new impairment model. Those were the ECLs. And you've got a lot of disclosure. IFRS 15, well, not a lot of effect for a lot of companies in this room, but there is lots of disclosure if it does affect you. And IFRS 16 affects almost all companies, and can be in a very big way, and you may not know that yet. There's only one type of lease with practical expedience, 12 months, $5,000. It requires consideration of all of the contracts that you have. It requires lease summaries and analysis. We'll be asking for that when we come and audit you and say hello, whenever that is. Net present value calculations, of course, lots of assumptions and lots of disclosure. And as mentioned earlier and discussed, it's got a pervasive effect on your financial statements. It hits everything. Final takeaways here. Q1, It comes pretty fast after the year end once those statements are finished, so you will not have time. Now is the time to get on it for sure. If you haven't already, what are you waiting for? What the heck? Thanks very much.